Hello and welcome back to Grow with Tony. I am your host, Tony. Today, we are going to slow things down. We are going to step away from the noise of the daily news cycle, ignore the latest meme stock that is trending on social media, and focus on the bedrock of a truly resilient portfolio. We are going to talk about going global. Most investors suffer from something psychologists call home country bias. If you live in the United States, your portfolio is likely dominated by U.S. companies. You know Amazon, you know Google, you know Apple. They feel safe, they feel familiar. But the United States, as powerful as it is, only makes up about 50% of the global stock market capitalization. That means if you ignore the rest of the world, you're ignoring half of the investment opportunities on this planet. So, how do you fix that? How do you capture the growth of the rest of the industrialized world without having to buy stocks on foreign exchanges, deal with currency conversions, or research thousands of companies you have never heard of? The answer often leads investors to one specific ticker symbol, SCHF, the Schwab International Equity ETF. This is not just another fund. For many, this is the cornerstone of their international diversification. But what is really under the hood? What are you actually buying? And is it the best option out there? Today, we are going to tear this ETF apart piece by piece so that by the end of this episode, you will be the absolute expert on SCHF. Let's start at the very beginning with the architecture of this fund. SCHF tracks an index called the FTSE Developed ex-US Index. Now, I know indices sound boring, but this is the most critical part of the podcast, so stay with me. The index defines the rules of the game. First, let's look at the word developed. This is a crucial distinction. In the world of investing, countries are generally divided into developed and emerging. Developed markets are countries like Japan, the United Kingdom, France, Germany, Canada, and Australia. They have stable governments, established rule of law, and mature financial systems. Emerging markets are countries like China, India, Brazil, and South Africa. They offer higher growth potential but come with higher volatility and political risk. SCHF is purely a developed market fund. You will not find Alibaba or Tencent in here. You will not find risky plays from developing nations. This fund is about stability. It is about investing in the old world economies that have stood the test of time. Next, look at the ex-US part of the name. This means excluding the United States. This is designed specifically to fit into a portfolio that already has US exposure. If you own an S&P 500 fund or a total US market fund, SCHF is the puzzle piece that fits perfectly next to it without any overlap. You aren't doubling down on Microsoft. You are buying what you don't already own. So let's take a tour of the world through the lens of SCHF. If you put $1,000 into this fund, where does that money actually go? Your biggest exposure is going to be Japan. Historically, Japan makes up about 20 to 22% of this fund. You are buying into the titans of Japanese industry, Toyota, Sony, Nintendo. After Japan, you are hopping a flight to the United Kingdom. The UK usually accounts for around 13 or 14% of the fund. Here, you are owning massive pharmaceutical companies like AstraZeneca, energy giants like Shell, and banking institutions like HSBC. Then you move into mainland Europe. France, Switzerland, and Germany are huge components. You are owning Nestlé, the largest food company in the world. You are owning Roche and Novartis in the healthcare sector. You are owning luxury brands like LVMH, the parent company of Louis Vuitton. And finally, you have significant exposure to Canada and Australia, which adds a nice layer of natural resources and banking stability to the mix. But there is one specific country we need to talk about because this is where SCHF stands out from its competitors. That country is South Korea. This is a technical detail that many people miss. There are two main index providers in the world, FTSE and MSCI. MSCI considers South Korea an emerging market. So, if you buy an international fund from Vanguard that tracks an MSCI index, it usually will not include South Korea. However, SCHF tracks a FTSE index. FTSE considers South Korea a developed market. This means when you buy SCHF, you're getting exposure to Samsung Electronics, one of the most important technology hardware companies in the world. You're getting exposure to Hyundai. This is a significant differentiator. If you want South Korea in your safe bucket, SCHF gives that to you, whereas other funds might force you to buy a separate emerging markets fund to get it. Now let's talk about the type of companies inside the fund. If you look at the US stock market today, it is dominated by technology. It is growth heavy. It is fast paced. International markets are different. They are what we call value oriented. When you buy SCHF, the weighting is heavy in financials, industrials, materials, and consumer staples. These are companies that make things, ship things, and finance things. They aren't usually growing at 30% a year like a Silicon Valley startup. Instead, they are cash cows. This is why SCHF is such a good partner for a U.S. portfolio. If the U.S. tech sector crashes, the boring, dividend-paying industrial companies in Europe and Japan might hold up better. It balances your risk. You are not just diversifying by country, you are diversifying by sector and economic style. Let's move on to the cost. In the world of ETFs, fees are the enemy. Every dollar you pay in fees is a dollar that isn't compounding for your retirement. Charles Schwab is known for being a low-cost leader, and SCHF is their flagship example. The expense ratio is 0.03%. Let me put that into perspective. If you invest $10,000 into this fund, the annual fee is $3. That is essentially free. It is the price of a fancy coffee once a year to own a piece of about 1,500 companies across 24 different nations. Compared to the industry average, this is rock bottom. There are other funds out there like the iShares Core MSCI EAFE ETF, ticker IEFA, or the Vanguard FTSE Developed Markets ETF, ticker VEA. They are all very competitively priced, but SCHF consistently stays in that lowest tier of pricing. However, we need to discuss the nuance of market cap. SCHF is a large and mid-cap fund. It focuses on the big companies and the medium-sized companies. It has minimal small-cap exposure, less than 1%, focusing almost entirely on large and mid-sized companies. Small caps are the tiny companies that have high room for growth but are riskier. Some of SCHF's competitors, like Vanguard's VEA, do include small caps. So if you are a purist who wants to own absolutely every single stock in the international market, down to the smallest little factory in Italy, VEA might be slightly broader. But for 99% of investors, the large and mid-cap exposure of SCHF is more than enough to capture the performance of the international economy. Now let's address the elephant in the room, performance and risk. If you look at the chart of SCHF over the last 10 years and compare it to the S&P 500, you might feel disappointed. The US market has crushed international markets for a decade. The US has had the tech boom, the AI boom, and a robust economy. Europe and Japan have struggled with slower growth and aging populations. So why buy SCHF at all? Why not just put everything in the USA? This is where the concept of cyclicality comes in. Winners rotate. Though the US has outperformed recently, remember this follows a period in the 2000s when international markets significantly outperformed the US after the dot-com crash. By buying SCHF today, you are essentially making a value bet. You are buying these international companies at much lower valuations, lower price-to-earnings ratios than American companies. You are betting that eventually the gap will close. You are buying low assets in high-quality countries. There's also the currency factor. When you buy SCHF, you aren't just buying stocks, you are selling the US dollar. Here is how it works. When the fund manager takes your dollars to buy shares of Nestle, they have to convert your dollars into Swiss francs. If the US dollar gets weaker over the next 10 years, your international investments become worth more when converted back. For the last decade, the dollar has been very strong, which has hurt SCHF's performance. But currencies move in long cycles. If the dollar weakens, SCHF acts as a hedge. It protects your purchasing power against a declining home currency. Before we start wrapping up, I want to touch on dividends. Because SCHF holds mature, older companies, it tends to yield a decent dividend. While US tech companies often reinvest all their profits to grow, European and Japanese companies have a stronger culture of returning cash to shareholders. SCHF pays its dividends semi-annually, twice a year, typically in June and December. This can be a nice chunk of change to reinvest and buy more shares, accelerating that snowball effect of compound interest. So where does this fit in your portfolio? A common strategy is the three-fund portfolio. You have your total US stock market fund, your total bond market fund, and then you have your international fund. SCHF is the perfect candidate for that international slot. Some aggressive investors go 50-50 between the US and international. Some conservative investors go 80-20. But regardless of the percentage, the role of SCHF is the same. It is the diversifier. It is the safety valve that ensures your financial future isn't tied to the fate of just one country's economy. We have covered a massive amount of ground today. We have looked at the index, the geography, the sectors, the costs, and the macroeconomic arguments. To make sure you walk away with the clear picture, let's summarize the key lessons of this episode. You have learned that SCHF is a developed market fund, meaning it focuses on stable, wealthy nations and excludes risky emerging economies. You learned that unlike many of its rivals, it includes South Korea, giving you access to major tech conglomerates. You now know that it is a large and mid-cap fund, heavily weighted in financials and industrials, which provides a perfect counterbalance to the tech-heavy US market. And finally, you know it is one of the cheapest funds on the planet, costing only 3 basis points, making it a highly efficient tool for long-term wealth building. That is the comprehensive breakdown of SCHF. It is not a get-rich-quick scheme. It is a get-wealthy-slowly vehicle. It is for the patient investor who understands that the world is a big place and opportunity lives everywhere, not just in their own backyard. Thank you so much for sticking with me through this deep dive. I hope this episode has given you the confidence to look at your portfolio with fresh eyes. If you found value in this breakdown, please do me a huge favor. Hit that like button, share this episode with a friend who needs to get their investing life in order, and make sure you are subscribed. And I have a question for you. What ETF or financial topic do you want me to cover next? Drop a comment below right now. Seriously, I read them all and I want to build the content that helps you grow. I'm Tony. This has been Grow with Tony. Stay disciplined, stay diversified, and I'll see you in the next episode.